The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
It is Thursday, the 6th of June. Great to have you back, Jeremy. How are things going?
Hi, Gareth. Yeah, good to be back. Yeah, not bad. How are things with you?
All keeping well? Yeah, been a busy week. So just getting down to the nitty-gritty straight away. What's been going on in the macro world?
It's all a bit bitty, really. This week has seen significantly weaker commodity prices, particularly energy prices. The oil price has been weak, and we've seen broadly lower bond yields and a lower level of the dollar. So This is sort of encouraging macroeconomic, easing financial conditions type environment for the rest of the world. And I think this is largely on the basis of increasing signs of a weaker US economy. So we've had ISM manufacturing output data lower than expected, and we've had fewer job openings than expected. So, yeah, along with some manoeuvring around OPEC and some of the politics around the oil price has meant that Brent crude as a measure is now well below $80 a barrel. And this is sort of the first time in several months, I think, since sort of early February this year. So that's a pretty positive setup for a sort of risk-on environment.
Yeah.
I'd caveat that with the fact that European gas prices are still low by the levels we saw during sort of 2022 spike, but up 50% since the low point in March this year. So these inflationary pressures haven't gone away, but for the time being, they've been pushed to the side. And of course, the big thing this week is that this is about rate decisions. And at last, we're starting to see evidence of central banks reducing policy rates.
Okay, that's good.
We had Canada yesterday. Earlier in the year, we had Switzerland and Sweden reduce rates. And this afternoon, we're expecting the ECB to follow suit and reduce rates at their meeting. That leaves the Bank of England and the Fed yet to move, but we know why that is. And we're almost certainly going to get a UK rate cut sometime after the forthcoming election, and almost certainly a rate cut from the Fed before the year's out.
Yeah. So US economy slowing down gently, hopefully not too fast, and that's helping keep inflationary pressures in check, although they're not completely gone from Europe, would be your summary. And the interest rate reaction is it a quarter of a point we're expecting from the ECB today? Is that right?
That's right. Yeah, I think we'll come down in small increments unless anyone decides to hit the panic button. We'll get evidence tomorrow from the non-farm payrolls.
Okay.
Obviously, we're in the year of elections, so politics has played a part in market sentiment this week. We started off with the world expecting India to return Prime Minister Modi with a large majority. The Indian stock market hit an all-time high on Monday, only to be greeted with the news that he's going to have to share power in coalition. And the market subsequently fell sharply. We've also had quite volatile moves in Mexico. And there it's because the presidential candidate who won with a much bigger majority than expected. So the normal checks and balances on her left-leaning tendencies is causing a few ripples in the local stock market and currency markets in Mexico.
Yeah, and you've been saying for a while, actually, haven't you, that the UK political risk is a lot lower than other places, and that's starting to show through. Some of them coming up with surprise results or results which could put in power some quite extreme parties, be it left or right, which, as you're saying previously, that worries investors.
Yeah, and I think looking forward is the European parliamentary elections and the repercussions of that. There has been talk of, and I think we're going to see the effect of, rising populism and nationalism within Europe, which I think will keep politics at the front of mind for investors. I don't think these things change long-term growth profiles of economies or the long-term direction of financial markets, but they clearly have an impact in the short, medium term. I remain of the view that the UK is relatively immune from all this, albeit we all get sucked into the media machinations of the differences between the two parties on offer in our election.
You saw a survey as well this week, you mentioned.
Yeah. We had a British Chamber of Commerce quarterly economic survey this week. They were saying the UK economy is expected to continue its recovery after the short recession at the end of 2023, but longer term growth is unlikely to be strong. Well, I think it's unlikely to be strong anywhere in the world right now, so I don't think we're an outlier on that basis.
No surprise, no. Yeah.
But after a weak 2023, they're saying that growth for 2024 and 25 have been revised upwards for the second forecast running. They do this on a quarterly basis to 0.8% and 1% respectively, with 2026 remaining at a 1% level of growth. The previous forecast was for 0.5%. Then they go on to talk about inflation, and they say, with core inflation proving stubborn, wages continue to rise ahead of inflation and geopolitical uncertainty persisting, the Bank of England interest rate is expected to be cut more cautiously than they previously thought.
Oh, okay.
The British Chamber of Commerce now forecasts a base rate of 4.75% at the end of 24, 4.35% at the end of 25, and just below 4% by 2026. And the final statement they said is, as we enter the final weeks of the general election campaign, businesses will be watching for politicians to show they have a sustainable long-term economic plan.
They will, yes, that's true.
Yeah, we'll all be looking for that. And all I only hope is that no one is holding their breath on this latter point.
Yes.
But I think it's interesting that they are saying that the inflationary pressures are lower, but they have not gone. And this is going to be occupying the mind of policymakers, not just in the UK, but everywhere in the Western world, that we are contemplating reducing interest rates when stock markets are at pretty much all-time highs. Asset values have been pumped up a bit in recent months. And while there isn't a sense of economic well-being, certainly as far as the UK is concerned, the pointers and the revisions are upwards, not downwards. Yeah. So I think the degree of interest rate reductions will be shallower than possibly we all hoped for earlier this year.
Understood.
On the point of surveys of what's going on in the UK, there's another one that was highlighted actually from the increasingly relevant City AM newspaper, which I think is worthy of note. And it was a group who called themselves the UK in a Changing Europe. And they were highlighting how successful the UK has been relative to nearly all other developed countries in growing its international trade for services. So things like financial services, legal services, communications, design and IP development. You know, an area where the UK and specifically London is a major global centre. And a quote they made was that UK services trade has been more resilient than almost all other advanced economies since the period before Brexit. Now, This is something that is very rarely talked about and discussed, but is worth reiterating.
No, it's good to hear the success stories where they are. And the services side can continue to grow. And it should be good opportunities if the rest of the world can balance its economic growth with managing inflation and bringing interest rates down slowly but carefully. So, okay, that's good to hear.
Yeah, and I think that's probably reflecting itself in something we've been talking about, that at some stage, the better than expected performance of the UK economy will be reflected in a better than expected performance of the UK stock market. And I think we've reported that that's been self-evident for a number of weeks now. But it's also reflecting itself in a resurgence or some form of recovery, at least, of the UK IPO market. So this week we had the Raspberry Pi IPO. It's almost a done deal. We're very close to it reaching the market. Mm-hmm. They've confirmed a valuation of £540 million, and it's covered at that valuation with a small list of cornerstone investors with a lot of orders yet to be taken. So it does feel like this is an IPO that's been handled very carefully.
Yeah.
And an interesting first step for a reawakening of the IPO market. And we've also had reports this week on a much bigger step, which is the Chinese online fashion giant Shein or Shine. It's going to be a big one. At its last private market valuation, it'll be about a £50 billion company, should it make
Right.
its way onto the London market, which would make it something like the 12th largest listed UK company in the FTSE. We haven't seen confirmation of this. It still might not happen. And I think when it does happen, it will be a whole different ballgame of controversy versus something like Raspberry Pi. But it is a test of the mettle of the London market all the same.
That's right. It certainly shows that their advisors think there's demand in London, which is good to see. And yeah, it'd be great to see Raspberry Pi out of the gates and hopefully performing well, but not too well in the aftermarket.
Yes.
We don't want people to think it's been too aggressively priced to go, but seeing a nice, gently positive aftermarket would be fantastic. Any other companies caught your eye in the course of this week?
Yeah, I think just back on the sort of bellwether stock that had results this week is Workspace, that owns a significant number of flexible workspace units in and around London. Its departing CEO reported that its valuation was lower by the tune of about 10% through the period, although the reduction was significantly lower in the second half, sort of highlighting that he thinks that the valuation now is at the low point.
Mm-hmm.
There's various trends going on here. There's this traded services sector industry report I was talking about earlier. UK generally, but London in particular, as a financial, legal, communication services hub, is something Workspace is a beneficiary of. The other trend is the trend back to the office. And if you want office space in a place like London, which is still an attractive place to work, then having a flexible, well-invested location, it makes a lot of sense. So yeah, it's a decent sized business, trades at quite a significant discount to its appraised £8 NAV, and is a decent dividend payer. So yeah, I think this sort of recovery in property and real estate generally with lower interest rates is becoming quite a feature of the London market right now. What about you? What did you notice?
Yeah, a couple of other stocks in the progressive roster. STV had a positive announcement this week that they'd seen ad revenue, I think, up 15 to 20% in their Q2, but that seemed to be sequentially stronger than Q1. So it feels like there is gradual improvement and recovery of markets. Clearly, that for STV, that ad revenue is boosted with the artificial or the additional impact of the football, the Euros coming through. So there's a bit of a demand spike there, but still good to see. And they're sounding reasonably upbeat about the way forward, which is good. CML Microsystems, the wireless semiconductor business, they were comfortable for us and the house broker to publish forecasts for the year 2025 for the first time, which shows a degree of comfort and certainty around their markets, which is nice to see. And we also had Springfield Properties, the Scottish house builder, signing a partnership with Barratt Developments for working together in that market. So again, some nice positive news flow from them and suggestive of confidence building and reassuring trends returning to some of those property spaces.
Yeah.
Just to wrap up then, what have we got lined up for next week?
Yeah, so we're going to have US inflation numbers and a Fed rate decision next week. But I think, unfortunately, neither are likely to bring much in the way of cheer. Year-on-year inflation in May in the US is expected to be reported as unchanged at about 3.4%, still some way above the 2% target. We know already that rates are likely to be kept on hold this time in the US, despite reductions being seen elsewhere.
Mm-hmm.
Possibly we'll get some cheer from the PPI data on Thursday, which should show a slower trend in the precursor to inflation in terms of producer price inflation. I think it'll be a better picture in the UK next week. We get UK unemployment data on Tuesday. But more importantly, we're going to get GDP month-on-month data on Wednesday, which is forecast to see a rate lower than March's 0.4. But I think if you believe what the British Chamber of Commerce were saying this week, then I think these forecasts are likely to be revised upwards.
Could be cautious, Okay.
Yeah. So up towards this sort of 1% level for next year.
Yeah.
So watch this space. The final sort of outlier next week is we got Bank of Japan interest rate decision on Friday, always an interesting one. Its current policy rate is 0.1%, so 1 basis point. It looks hopelessly out of touch with anything else on planet Earth, and more significantly, out of touch with a Japanese economy that is showing increasing signs of inflation and wage pressure. So how they square that circle is an ongoing puzzle to me, but let's see.
Okay, well, could be some fireworks there. Thank you very much for your time. Good to catch up.
Okay.
And we'll speak again next week.
Okay. See you then.
Brought to you by Progressive Equity.